Hello, everybody. It's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. Last week, I did a video on mid-cap growth stocks, mid and small-cap growth stocks. So this week, I'm going to switch gears and look at income stocks and talk about investing for income as a strategy and how that strategy differs from trying to invest for a total return or a growth strategy. Okay, and there really are some differences. And I want to put something out here. Not all common stocks should be invested in for the same reason. Everybody focuses on, well, how much the price went up or how much the price went down. I believe you should invest in stocks according to your needs, goals, objectives, and risk tolerances. Those things are all important. But what you should do is have a clear vision in your mind of what you're trying to accomplish when you invest in the stock, and also then what you think that stock can do for you. So we're going to look at some income stocks today. So let's go ahead and go to the fast graphs and let's look at some stocks, 6 stocks that I picked for dividend and dividend growth. The 6 stocks I picked here are Realty Income, Eversource Energy, Black Hills Corporation, UGI, Bank of the Ozarks, and Becton Dickinson. And I've covered a couple of these in just recent videos already. Most of them are investment-grade credit ratings. UGI or Bank of Ozarks does not have a credit rating. It just simply means it didn't ask for them. But here are the things I focused on, and I want to be real clear about this. I focused on dividend growth. How consistently did dividend growth? What was their score? Okay, and all 6 of these had 100% dividend growth scores. They've all paid dividends for 20 years or more. Okay, and that means they've increased their dividend every year by having a 100% growth score. Because that's what I'm looking for. One of my points when I'm talking to people about investing for income is that you work hard all your life saving and building up your portfolio. And then when you finally get to, for example, retirement age, it's time then for that money to work hard for you. You worked hard for it all your life. And one of the things about investing in equities for income versus bonds, what I was taught early in my career, it's loanership versus ownership. I prefer being an owner. Some people prefer being a loaner. The problem with being a loaner, that means buying bonds, CDs, fixed income investments of all sorts, is that typically you get a coupon. That coupon stays the same, which means it faces the ravages of inflation. Okay, inflation can really destroy that return or that yield over a long period of time. They are considered safe. You do get your money back, but again, you get a nominal return back. In other words, if you invest $1,000, you're liable to get $1,000 back, but that $1,000 is not likely to buy what it did when you started out. So the difference between ownership is that you can participate. Now, it takes more risk to invest in ownership. That's really a given. But is it real risk? Like one of the things I was taught also young in my career, one of the problem with fixed income was it was guaranteed in many cases, or close to being guaranteed, but this particular gentleman called it guaranteed failure. You take away taxes and inflation, and you end up not making any money. So I tend to be an ownership kind of guy, but you have to make that decision for yourself. So I've listed these stocks here. I've listed them by dividend yield. Now, we've got 4 of them here that are yielding over 4%, which is a relatively high yield. But remember, this is the starting yield, and I'm going to talk about that more throughout the video. Then we've got Bank of the Ozarks, which is yielding 3.43%. And then we got Becton Dickinson, which is only 2.13%. And this is a dividend champion, all right? But we're going to go through these kind of one at a time based on their current yield, all right? Actually, what I'm going to do is, because it makes it easier, I'm going to go through these looking at them in alphabetical order. So I'm going to go ahead into the fast graphs here, and I'm in the summary page, and I'm going to go ahead and switch now to the historical chart. And there's reasons for that because I've got less detail, but I've got more functionality. So here's what I'm going to do with each of these, and I'm going to do different time frames. But what I want you to understand is a concept called growth yield. Now, people call it yield on cost, and this is the real advantage of investing in income. So if I shorten the time frame here by 1 year on Bank of the Ozarks, I want to start out where the valuation was below a 15 PE. And here you see we're starting out with 11. That means I'm going to focus on the growth rate over this period of time of earnings, Now, if I buy it in value and it's trading on the orange line, I'm going to get a return that's about equal to that growth rate. If it's undervalued, like I think Bank of the Ozarks currently is, then I'm going to get a lower rate of return. But I want you to notice a couple of things here, and I'll do this with all of these companies. The reason I like income stocks, and even if you think about people that like bonds or fixed income, if I look at the lines on this graph, okay, I'm going to kind of build the lines for you. The first line is the orange line on the graph. Okay, this is a plotting of the company's earnings. It's a pretty consistent line, but it does have some peaks and valleys, some dips, if you will. All right, but it's pretty consistent, and we got an average growth rate over this time frame that we're measuring of about almost 15%, 14.85%. Okay, the most inconsistent line on the graph would be the weekly closing stock prices. You see stock price volatility is all over the place. There are times when the market overvalues stocks, times when it undervalues stocks, and it's doing that now. But the other point is this is a very nervous line. And it's very hard to predict. And people are always worried about stock price. And my argument is quit worrying about stock price because stock prices are unpredictable. But what is the most consistent line in this graph? It's the gold line, which is the dividend and the dividend growth. And this is so important to understand. This company has increased its dividend every single year in this graph. And they even increased things like their payout ratio. Back in 2010, they were paying 16% of their earnings. Last year, they paid out closer to 26% of their earnings. So they still have room to grow. Now, they're yielding 3.43% currently. All right, now that's kind of important when I look at performance here. So I'm going to go to the performance graph using fast graphs over this time frame. And I'm going to go to the numbers and avoid the graphs here. And what I want you to see is a couple of things. This is very comparable to the S&P in every format, meaning growth and growth of income, except for total dividends, and I'll cover that here. So we would have started out with a 1.75% yield on cost back here if we'd have bought this stock. And again, the date we would have bought it would have been on 12 December of 2008, okay? And we're ending it on August of 2025, okay? And the growth rate, the growth of the performance of the portfolio was 12.11%. The S&P outperformed it at a growth rate of 12.54%. So this is a pretty growthy stock. So the comparison is pretty equal there. But look at total dividends. This company would have paid you $17,000 in dividends, over $17,000 on a $10,000 investment, and the S&P would have only paid you $8,000. So you're looking at twice the income. So if you're an income investor, in this case, you actually outperformed the S&P in total return. But the real key here is not whether you get a higher total return, it's whether you get more income. If you're a retired person living off your income, that's what becomes important. So now I told you it's yielding about 3.46% now. So I'm going to focus on a comparable yield, okay, after you'd have bought this stock. That'd be 2012. But look how you would have started out with 3.37, increased to 4.86, then to 6.34. And by last year, your income would have been over 20%. Okay, that would be your yield on cost, as they call it. I call it growth yield. The point is, for a $10,000 investment, because here's another point that you're going to see with all these. The number of shares is the same in each year, okay? And your income on a $10,000 investment, one-time simple $10,000 investment, the year I picked would have been $337, then it would have gone to $485, then to $624, then to $700, $800, $1,000 or $900, over $1,000, and so on and so forth. Okay, that's what growth yield is all about. Now, this is just using a $10,000 example. With FastGraph, you can actually put your actual numbers in if you choose. Okay, so that's basically our first example here, which would be Bank of the Ozarks. Okay, it's one of the growthier stocks in the portfolio. So let's go ahead and go into the rest of these here now. Let's go ahead and move. Let's now go to Becton Dickinson. Let's go into the next stock on the list here and go into Becton Dickinson. Now, again, I'm just going to remind you of things. The orange line is pretty consistent. The black weekly closing price line is all over the place. And once again, we see this very consistent dividend growth. Now, I'm going to shorten this one more year because I want to start at value and I'm ending close to value. Always check the FastVax box. I've got 6.89% growth. Okay, I've got a dividend yield of 2.13%, which is relatively low, and I've got earnings growth of just under 6.89. So let's go into performance and let's look at our numbers here. I've got an annualized rate of return without dividends of 6.86, very close to the growth rate of the company. All right, I've got a total return that underperformed the S&P by quite a bit. But again, I'm investing for income and I'm living off the income and I'm not selling any shares. I'm not harvesting anything. I'm just doing it. Once again, my number of shares stays the same each year on a $10,000 investment. And my yield on cost grows from 2% to well over almost 6% by year end 2024 and expected to grow again this year. All right, so getting back into the historical chart again here, what I want you to see is we had started out at fair value. We ended just a little bit below fair value. But what we did was we got this consistent dividend. Went from $1.44 for $1.60, $1.75, $1.93. And since our share count didn't change, our income is simply increasing each and every year. And that is what's critical when you're looking and investing for income. So let's go to the next stock. Let's look at Black Hills Power. Now, this is a slower growing multi-utility stock here. It's only growing at 4.6%, but it has a 4.48% dividend yield. Now, once again, I'm starting out a little bit undervalued because that's, as a value investor, I always want to be buying on, at the minimum, below, even better, the orange line. And I'm trading right on the orange line. So I'm going to expect a performance here on this particular, when I go to performance, of something over 4.6%. How did I get that? I bought the stock a little undervalued at a 12, almost a 13 PE. It's now trading at a 15.27 PE, so I've got a little PE expansion. I would expect to have a growth over 4.6%. So let's go ahead and go into performance, and let's look at my growth score here. My growth score was actually 5.37%. That's because of some volatility. But once again, let's compare dividend income. The S&P, once again, outperformed this stock by almost double on total return. But again, a bond would have shrunk in value. Remember what I said at the beginning. If you'd have put $10,000 in a bond yielding the same yield, your bond would depreciate over this period of time, not appreciate like the income did. But the real key here, you'd have got $11,000 in dividends versus just $6,670 in dividends over this time frame. And once again, your yield on cost would have increased dramatically. So when you're investing for income, as an income investor, now remember, look at all this volatility of the black line. Everyone's so price conscious. This is the consistent line on the graph. The dividend literally increased every single year. And I do want to make a point. The dividend for this particular company grew at an average rate of about 4%. All right, that's approximately what the company's actual earnings growth was. Again, that's a consistency of income. So you're getting an income growth, and you're starting out with a yield of 4.48% in the case of Black Hills Corporation. Moving on, let's go to Eversource Energy. Now, once again, I've got a stock that's trading at about a 13 PE, 13.5 PE when I bought it. It's about the same. Earnings growth rate was 5.88%. So I go into my performance and I look at my growth return was 6%. That's very consistent with the growth rate. My dividend grew at 8% a year. But the big advantage is I'm starting out at a much higher yield than I had on the S&P. So again, I end up with $11,750 in dividends versus $6,670 if I put an equal amount in the S&P. The S&P once again outperformed me on a total return basis. But what I got was this rising income stream. And what it's really not trying to compare this to the S&P in this case, because what I'm really trying to compare it to is an income vehicle. So I've got stocks or bonds. I've got loanership or ownership. ownership is much better. I do get some capital appreciation. I get more income than I can get from just investing purely in the stock market, and I get this consistency. Again, I've got a lot of volatility in the stock price, but I got really 100% consistency in the dividend growing every year for me. Moving on to the next stock on the list will be Realty Income. And this is a REIT, a real estate investment. This one pays monthly income. I've got a yield of over 5.58%, which is very attractive. So if I go into performance, again, 5.34% is what I want you focused on. I go into performance, and what I see here is that I get performance of 5.49, almost perfectly in line with the growth of the funds from operations, in this case for a REIT. Again, it underperformed the market in that case, but it generated $15,000 in dividends on a $10,000 investment versus only $6,000 in the S&P. If you're investing for income, this would be the far superior choice. And your yield on cost would have more than doubled over the holding period here. Okay, that's what the advantage of investing in dividend growth stocks. It's not about beating the S&P 500. That's not your objective here, except on one area, and that's income. You are trying to beat the S&P 500 on income with these stocks because you're living off the income. And you try to build a portfolio whose current yield is high enough for you to have enough income to live comfortably off as you've always lived, but you're also getting a raise in pay. You're fighting inflation in two ways. Your income is going up, and you've got some capital appreciation here, and that's far better than you can get on fixed income. There's the price volatility. That's the risk that a lot of people concerned about. Modern portfolio theory calls volatility risk. I don't think it is risk because the idea is you're buying a great business focused on the orange line, and the orange line in this case is pretty darn consistent, and you're not worried about the price going up and down. What you're worried about is how much dividend income this is paying you, because once again, when you look at performance, your original $10,000 investment bought you 398.55 shares, and that didn't change anywhere during this holding period. What changed was your income kept increasing year after year. Okay, and once again, you got a pretty good rate of return on this stock compared to the market on total return. But once again, you got $15,000 in dividends versus $6,670 in the market. You got a lot more income, and you fought inflation by investing in this company at this level when the valuation was correct. And again, I'm picking periods where I'm starting out at a reasonably attractive valuation because I want to compare apples to apples here. So moving on to Bank of the Ozarks, which we've already covered. We're looking at a stock here that is well undervalued and had really high growth. Okay, moving on, let's go look for UGI, which is a utility stock. I'm starting out at fair value. It's a little undervalued. I've only got 5.5% growth, which is common for a utility. This happens to be a gas utility. It's yielding 4.34%. Looking at performance, once again, I underperformed the market for this particular time frame that I've measured here, but my dividend growth has been high. I ended up getting almost double the amount of income. My dividends were $10,000 versus $5,000 plus on both categories. Investing in this stock, and it's undervalued and still gives me opportunity. I might point out in measuring the S&P here, the S&P is overvalued. But again, this is not about beating the S&P 500. What this is all about is outperforming a fixed income investment based on income. So even with a low yield stock like Becton Dickinson, you're going to get a heck of a lot more income in the long run if you apply ownership over ownership. You do technically take more risk, but I think the guaranteed risk that you take when you buy fixed income is you're going to get ravaged by inflation and of course, taxes. You're going to get ravaged by taxes on ownership as well, but you do have some inflation-fighting attributes. You've got rising income, and you've also got the opportunity to have your original investment grow over the period of time, depending on how fast the company is capable of growing its business. So anyway, I hope you've enjoyed this income look at investing for income. You've got different yields here. I went from a moderate yield, just slightly better than the market on one case, to stocks that were yielding several times or more than twice what the market was yielding. But the key is the growth of the income. You've worked hard for your money all your life. It's time for you to let your money work hard for you, and you deserve a raise in pay. And a good dividend growth stock can give you that raise in pay every year. And it could keep the ravages of inflation from lowering not only your income, but also your capital as well. You may not outperform a growth stock, for example, but you certainly outperform fixed income investments by doing this. Thanks for watching. If you liked the video, ring a bell. By the way, if you own stocks, subscribe to Fast Graphs. What a powerful tool, and certainly the value investor's best friend. But give me a like, ring the bell, all that good stuff. Thanks for watching. I'll be looking forward to talking to you again real soon.